Hello everyone and welcome to Lunch Investing. Today I want to discuss the topic of overpaying for high growth, big mod companies in the stock markets. Before we go any further, let's look at what Terry Smith has to say about this.
Of course, there's one other thing. You actually have to buy these things at the right price. I said at the outset that most fund managers that I met didn't try to buy good companies. A small number of them did, the ones that I met. But even some of those still managed to perform badly. And they'd say, well, why is that? And I said, well, I think you're just paying too much for them. No matter how good the company is, if you're trying to do a buy and hold strategy, you can't overpay for it because you're not trying to play the Greuter Fall theory of investment. You're not trying to sell this onto somebody who will overpay even more than you. You're going to hold this for an indefinite period. So you can't pay too much. So we use some very simple methods of determining valuation. The prime one we use is free cash flow yield. What's the free cash flow of the company divided by its market value? That's what we look for. We also look at the dividend yield. People forget that on equities, the dividend yield is a very significant part of the return. Go back up for the last 100 years, and dividend yield is more important than capital gain on equities. It's only bull markets that make people forget that. So we look at some very simple metrics in terms of working out what the valuation is that we should pay. What don't we do? I've said what we do. We don't market time with our fund. If you invest in our funds, it will always be fully invested in equities of the type that we name. We don't hedge anything. We don't hedge currencies, interest rates, or anything else. We don't think it's necessary, and we don't know how to do it. And I say that even though I'm the chief executive of the second biggest currency broking firm in the world. We don't actually ever try and hedge currencies. We have no clue where they're going. If you do, you can hedge the currency, basically. You can see where the companies are located. You can have a go at it. Good luck to you, basically. We don't trade frequently. We try not to trade at all if we could possibly do it. We don't short anything. It's a long-only fund. We don't panic when markets fall. Equally, we don't run around high-fiving each other when markets go up. We're looking at owning these companies and owning their underlying cash flows to all intents and purposes forever. Short-term price movements for us are either just an opportunity or a pain in the butt. They're not actually making a difference to the underlying value of the portfolio. And there are lots of sectors we won't invest in at all. One of the nice things about this and the way that we run it is there's loads of things I don't need to know about. You know, airlines, don't really care, never going to invest in one. They're basically, airlines are an opportunity to lose money and annoy people. That's the only two things you can do if you run an airline, as far as I can see. So I travel a lot in my life. We won't ever invest in banks. They need leverage. We won't invest in insurance companies. We don't invest in the mineral sector or the oil sector or any of these things. They're all cyclical. They have no brand value whatsoever. So there's loads and loads of businesses out there that we never even have to think about.
I noticed that many investors tend to follow the hype and buy stocks like Nvidia and Tesla at any price, just because they have a lot of momentum and innovation. A few years ago, the same thing happened with ARK stocks that Cat Wood was buying. These investors believed that these companies were going to change the world and that no price was too high for them. But is this a really smart way to invest in the stock market? We heard from Terry Smith, who is also known as British Warren Buffett. Unlike Buffett, who is mostly influenced by Ben Graham and his value investing principles, Smith is more inspired by Phil Fisher. Buffett once said that he was 15% Fisher and 85% Graham. But I think Smith is the opposite. He is 85% Fisher and 15% Graham. So what does this mean? It means that Smith is willing to pay up for great companies, but only if they meet certain criteria. He doesn't just buy any stock that has a high growth rate or a large competitive advantage. He also waits until the price is right. Fund Smith has a very easy approach to investing that you most likely have heard if you knew about them. Buy good companies, don't overpay, do nothing. I believe 2 out of those 3 are easy to understand. Buying good companies. Well, we all know Tesla, Nvidia, Costco, Microsoft, Nike, and many more great companies. Doing nothing. Well, that's very easy to understand, but incredibly hard to do. Yet, we understand it. Not overpaying, however. That's where it gets real tricky. Now, this is not a valuation video, so I'm not going to go into the detail about discounted cash flows, sum of parts, or any other method to determine a company's worth. Also, I use Monish per price method, in which if I need to open Excel, it is too hard for me. The company that I'm looking needs to scream at me that it is a buy. First of all, buying great companies is an incredibly great method of investing, and that's what the greats like Munger and Buffett have been doing. If you bought 2% of every Nifty 50 stock, even though there is a debate about it, one of those would be Walmart. And that 2% position in Walmart alone would have outperformed the S&P 500. And there were other great companies in Nifty 50 as well. Or if you invested in tech bubble in the early 2000s and simply held on to Amazon, assuming you could stomach the 90+% drawdown, you would have still come out alright. What I'm trying to point out is that you could have realized the brilliance of Jeff Bezos, but at the same time, you could realize that the valuation of the company was not based on their financials. It was based on emotions. It wasn't long-term thinkers like Bezos himself that was buying Amazon stock back then. It was traders buying the company at 10 a.m. in the morning and closing the position before the markets close or in the next day with a profit. Because for a long time, there was a greater fool that was buying it from them with the hopes of finding an even greater fool. So you could just add Amazon to your watch list, and Amazon in 1999's high was $113. The low in the crash was just $5.51. So instead of just beating the market, you could have created a generational wealth because Amazon returned almost 500x from the lowest point after the crash. Today, Tesla's market cap is around $500 billion. Nvidia's is a little over $650 billion. The biggest company as a market cap today is Apple with around $2.5 trillion. So assuming these companies will be the biggest ones, your returns would be 5x with Tesla and a 4x for Nvidia. And that is assuming they are the biggest companies of planet Earth. As individual investors, it can be tempting to invest in high-profile, well-known companies like Tesla and Nvidia. However, as we have seen, these stocks can often be overvalued or fully valued, and your returns will match the markets if not lag them. Investing in Tesla at a $500 billion valuation is much different than investing it at $50 billion even though you own the same stock. Instead, I believe that individual investors should look for opportunities in smaller, lesser-known companies. These companies may be more difficult to find, but they can offer greater potential for mispricing and undervaluation. By doing your research and seeking out these hidden gems, you may be able to find stocks that are undervalued by the market and have significant growth potential. While investing in smaller companies does come with some additional risks, the potential rewards can be significant. So the next time you are considering an investment in a high-profile company, think about whether there might be better opportunities out there in the world of small-cap and mid-cap stocks. By keeping an open mind and doing your homework, you might just be able to find the next great investment opportunity. It is also worth noting that companies can create shareholder returns through stock buybacks as well, even if the market cap stays the same. With fewer shares outstanding, earnings are spread across a smaller number of shares, which can boost earnings per share and drive the stock price higher. So Apple, for example, can give its investors a 2x without reaching a $5 trillion valuation through stock buybacks. Another example is Monish Pabrai believes that Turkish stocks are the most mispriced stocks, and there are a lot of bargains out there. And I recently made 2 videos about TAV Airports, where Monish owns 5%, and Research Logistics, where he owns a third of that company. You could check those out if you want as well. I will leave a link in the description. But also, that doesn't mean there won't be any opportunities in large cap stocks, like we have the example of Amazon 20 years ago. I believe another great example would be Meta very recently, 6 months ago. Meta was at a $230 billion valuation because I guess people thought that Mark Zuckerberg went crazy. I actually made a video about Meta after their first run-up where they went back to $180, so if you want, you could check it out. And Terry Smith recently said that Meta was still the cheapest stock his fund owns at the 2023 Fund Summit meeting. You could check that out as well. I also left a link to full meeting in that video. So that was it for today. I hope you liked it. If you did, please leave a like and subscribe. It really means a lot. Other than that, I'll see you in the next time.